Welcome back to All Things Money. Today we're taking a look at one of the most basic investment decisions, which is how to divide your money between stocks and bonds. And within those strategies, there are, of course, all sorts of different variations that you can get into. But the most important thing is figuring out what percent in stocks or growth type assets and what percent in income paying type assets you want. And we went through some historical returns. I suggest that you get yourself, I got this chart, and you can get them many places that lay out the returns from 1970 to 2009. And what we see is the return from 1970 to 2009 with all its ups and downs and bear markets and bull markets. Actually, the average return has come up to be roughly in line with longer historical periods back to the 1920s and even 1800s. So we look at the period 1970 to 2009 as a good proxy for for global equity market returns. And we're saying that the risk that you're willing to take as well as the return that you need to reach your objectives are the most important things to figure out. If you look at and say you as the little example we did, in 25 years you want to have $1 million and you need to make 12.7% rate of return, well, that necessitates investing in 100% equity. And remember, there are no guarantees to these type of returns, and they certainly vary by the environment that you start in. But to reach that type of return, you certainly need to be just about fully invested in equities. But that would cause you to endure some serious drawdowns of up to 50% or more in a year. A lot of people, most people, frankly, are not willing to endure that. And so then you have to add in some fixed income to the mix. As it turns out, since 1970, a 40% equity and 60% fixed income is the break point of a 5-year positive return. The worst 60 months of that was a plus 1.6%. The 50-50 mix between equity and stocks returned almost 10%, but in return for that, you had to endure almost a 29% drawdown over a year, which, by the way, a 50-50 mix, 50% equity, meaning U.S., foreign, large, small, emerging markets, a little bit of real estate added in there. That return of 9.9% equals the S&P 500 return of 9.9%, but its risk level is almost half. Its worst month was minus 12.8 versus minus 21. Its worst 12 months was minus 28 versus minus 43. The point of that is that although diversification gets beat up a lot and it goes in and out of favor over time, that we still believe that diversifying your assets around the globe in different types of companies, different sizes, different industries, different sectors, some real estate, some commodities, and not just in the S&P 500 or the Dow or the NASDAQ, that you come out much, much better ahead in the long run. So that's kind of what we wanted to cover. The most important thing to summarize is determining that mix between stocks and bonds. And when your return goal requires that you take more risk than maybe you're willing to, we always advise that people go with the lower amount. I've never seen somebody invest over their risk tolerance that didn't get very spooked in a bear market. And so the better strategy is to accept a lower return for less risk. Keep in mind, though, however, that 100% fixed income is a less than optimal strategy. It carries more risk, believe it or not, than adding just 10% stock to the portfolio. So if you have any questions on that, feel free to give us a call or email, and we'll be happy to give you some more information on that. Our first question comes from Marie. She likes bonds and investments, and she's heard a couple of terms, a barbell, ladder, and bullet strategy. And she wanted to know what these type of strategies are as related to fixed income investing. And that's a great strategy. There are 3 different ways of looking at investing in bonds, and this is when investing in individual bonds. The barbell strategy is essentially taking the two ends of the yield curve, meaning very short-term maturities, say a 1-year or 2-year bond and a very long maturity bond, say, or 20 or 30-year bonds, and you create this barbell. And you completely ignore everything in the middle. So you don't own anything that matures between 2 and 20 years. You just have the two ends of the maturity curve. And the reason that you do that is on the long end, typically you get higher interest rates. The bonds at the long end also go up and down in value a lot more. And if rates go up, their value goes down very quickly. You balance that out with bonds on the short end of the curve for your stability of principal and relative safety in terms of fluctuation in value. And so that's what we call a barbell strategy. A bullet strategy is where you pick one point on the yield curve, say the 10-year, and you constantly buy 10-year maturity bonds at varying intervals. And so you're focusing in on one maturity level, and you're varying, say this month you buy a 10-year, and then 6 months from now you buy another 10-year. That's called a bullet strategy. A laddered strategy, which is the strategy that we tend to prefer, is where you take a ladder of, you buy a 2-year, a 5-year, a 10-year, a 15-year, a 20-year, and you buy a bond at each one of those maturities. And so what happens is, as the 2-year maturity, as the 2-year bond matures, now everything is 2 years younger, and so now you have a gap at the long end of the curve in the 20-year. So when your 2-year maturity matures, you purchase a 20-year maturity bond or a 30-year or whatever the end of your ladder is. We typically, when we do bond ladders, we typically don't like to go out more than, say, 10 years. So when that short bond matures, you take the proceeds and you put it into the long maturity. And so now, your 5-year maturity is now, in 5 years, now it matures, and you take that bond and you roll it into the longest maturity. What the ladder strategy does is it protects you better from rising interest rates as well as falling rates. You still benefit because you have bonds at each maturity along the curve, and there's something maturing all the time. A lot of the studies that I've seen have shown that an effective ladder strategy is the best way to maximize your fixed income returns with individual bonds. Well, that's a great question, and if you have any other questions, feel free to email us. But that's all the time that we have for tonight. For All Things Money, I'm David Blain. Hope you enjoyed the show, and we'll see you again next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.